You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we do our very best to make investing simple. And I have a wonderful guest back on the program. He's one of my favorite guests, as I've read his books and had the chance to interview him in the past. It's really been a treat to get a sense of this individual, get to know the man, not just what he did. So we have a special treat. We have the father of the 401k, Ted Benna, back with us. And just to introduce him, the more I've gotten to know him through our interviews, through our chats, and also through reading his books, I just have to say that he's become one of the most genuine people I've ever met. And I remember the first time I asked him to come on, just to let you guys know what type of person he is. The first time I asked him, I was a little nervous because I wrote a book that was rather critical of the 401k system, mostly on what Wall Street has done with it since, Ted came up with this idea. But I asked him, I said, hey, is there anything you'd like to, any book you'd like to promote or anything like that? He said, Andy, if there's one thing you wouldn't mind is I have a charity, Compassion International, that sponsors children and helps bless those children who are in poverty and who struggle. And if you had a chance to mention that charity, Compassion International, that'd be good. That'd be better than promoting anything I have as an individual. And so I let you know kind of what type of person he is. For those of you that are people of faith, you'll appreciate there's references in the New Testament where Paul's never ashamed of what he believes. And I will tell you, Ted is a man of faith. He's a man of principle. And I'm proud to feel I've talked to him enough that I can call him a friend. So with that introduction, Ted, thank you for taking some time to share some insight today in this crazy time in terms of retirement. Thanks for being back on the program.
Oh, hey, well, thanks, Andy. Hey, I'm kind of hesitant to open my mouth after all that. I might not live up to all that wonderful expectation you've created.
Oh, you're one of the most genuine people that I've interviewed. And, like when you, I'll recommend first your book, 401k 40 Years Later. And you and I spoke when you launched that book, and I knew when you were writing, I told you I was going to be your first reader, and I kept that promise. It gives, the word I would use is insightful, because no one can tell the story of how that came to be better than you can. And it really helped people understand, I think, the environment. I think it helped people how it's exceptional. What bothered me is after it came about, Wall Street just took that thing over, and they were like, my gosh, you realize we can get a piece of everyone's paycheck, and the fees went out of control. And I'll refer people to your book to learn about that, but it's so insightful to just kind of feel like you were a fly on the wall watching you, have these, strokes of inspiration on how it might go. So, but today we're here to talk about a new book that you've put out in 2002, 20 years ago. You wrote 401k for Dummies in the there's that wonderful yellow, everyone knows the cover of those yellow books in the library. If you want to get something, made simple for you, go buy Investing for Dummies or 401ks for Dummies or whatever. They asked you to come back after 20 years and revisit this and include IRAs, correct?
Yeah, that's right. What happened, Andy? They wanted to do an update, but, since, of course, IRAs are, extremely important today, maybe as much so as 401k, they wanted me to do both. And so it was a bit of a challenge, adding the IRA and, updating it, because a lot has happened to 401k, over those 20 years as well. So, it was a significant effort. I was glad to get it out. It went on the market about a year ago now, 401k and IRAs for Dummies.
You're right. There's been tremendous changes, not just in the how 401k is structured, but in the world we live in. It's funny. My two sons are 14 and 16, and my older son, between the 8th and 9th grade, we took a year off, and I homeschooled him on financial education. And it was an amazing experience to spend time. I was kind of scared to do it, but I'll tell you, to have that 1 year with your son where he was your pupil and you were his only teacher, what a priceless experience. So his younger brother wanted to do the same thing. And as I've gone through a lot of data and charts with him and started teaching about things like the Federal Reserve, it just hit me the other day, the vast change that he will face growing up trying to figure out retirement as opposed to what you and I did. So it'll continue to change, I imagine. So tell me, let's start with this. When I read your book, you talked about, how the 401k came to be in your involvement. You said, well, it was an answer to prayer. You had some God-given ability and some mathematical training, analytical ability and mathematical training. And you've always had great insight. And the last time we spoke together, we talked about the unsustainability of our current path fiscally. We talked about the unsustainability of the monetary policy in place. And now I think the worst job in the world would be Fed chair. I wouldn't want that job. So can you give me your overall sense of inflation, the market, rates, war in Ukraine, just the whole milieu? How do you see the economic world right now?
Well, very clearly, if you just scan, the headlines, here and, worldwide as well, Andy, they continue to become increasingly more troubling. We have, moral, political, and economic, situations close to breaking down. Very, very clearly, it's not heading in a good direction.
That leaves people with an interesting choice to make. We have institutions and systemic programs like 401k and IRA are very systemic in my nature, in my view, in nature. Individual retirement account sounds individual, but my feeling is I don't have a lot of confidence and faith that our institutions are doing a lot to fix or to answer. It seems like there's more selfishness. It seems like there's more groping for power and grasping for power. And I almost believe that with the IRA being important now, that a person does take a more of an individual role, because the confidence in the institutions to fix these things, to me, is waning. Your thoughts on that? I mean, is it time for an individual to say, look, this is my life. I need to get smarter. I need to take a greater role in this because there's so much breakdown in institutions. Yeah,
I think you're right on target, Andy. When I was originally writing the 401k 40 years later book, my intent was to do that as an update of the Escaping the Coming Retirement Crisis, which I've written, I think it was back in 1997 or earlier, if I remember. Maybe, that's probably even before that. And in that book, I was looking ahead to the decade that we're now in. And, one of the things I pointed out is probably one of the most compelling socioeconomic issues we would be dealing with would be tension between retirees and workers, of the burden that workers would have of maintaining the system that, retirees were dependent upon. And, I was going to do the update of that, and I was intending to title it an update of Escaping the Coming Retirement Crisis and whatever. And I did the draft, and then I got back, into finalizing the book. And as I was doing that, I realized two things. One was the fact that if I used Escaping the Coming Retirement Crisis in the title, buyers might think I had an answer, and I didn't. So that was a problem. And the other was I realized, well, hey, we're at the 40th anniversary of 401k, so let's retitle this thing and reshape it a little bit, to make that the focus. And definitely systemic breakdown, federal, state, local, and otherwise, it's definitely got to be a major concern.
I've been grateful that you've remained vocal I mean, 1980, 81, January 81, you and really Johnson company, you launched the first 401k, but you've been vocal on these changes and you've been vocal on what people need to do. I'm going to read a little statistic to you and get your insight on this. One of the reports I look forward to every year is from Vanguard, and it's called How America Saves. And I think you probably are up on the numbers better than me, but my feeling is there's about $11 trillion. Well, maybe there's not any more after where the market is now, but in 2021, there was about $11 trillion in contribution retirement programs, and Vanguard has almost $2 trillion of it. So that's a pretty good sampling, in my opinion. It's a pretty darn big sampling. And what flabbergasts me is when they come out with the report How America Saves every year, the first thing I go to is their demographics. And this is interesting. According to Vanguard, and this is in 2021, and this is at the height of the market, right? This is the highest the market's ever been when this was put out. In 2021, the person who is aged 55 to 64, the median balance of a 401k in Vanguard is $89,000. Now, if you take the 4% withdrawal rule, or if you just divide that by 30 years, either way, it's about $299 a month. That's what, and less than half of the participants will have $299 a month. That's brutal, to where Vanguard's getting, they're pretty fair in their fees, but they've got a lot of money coming in. Over half those people who need it the most right now. I just think it's time for them to read more and get that IRA going and get going so they can have retirement. What's your thought?
Well, definitely. I think probably a key point here, Andy, is 401k and IRAs were never intended to be a means for most people of having a sufficient level of retirement income.
Yeah.
401k politically was a fluke. We don't really have time to go into that. What I did was figuring out a way to use it very differently than what was intended. So it was never intended to be the primary way for people to save for retirement. And, I know in my own situation, fortunately, I've, in addition to those type of ways of accumulating and, providing for us, I've been involved in, significant amount of whole life insurance. I have, rental properties, as well that were significant factor, diversification, just beyond, pumping money into 401k and, and IRAs.
What you've just said is a blessing to so many people, because I've been saying is the same is true for myself. I'm not a real estate tycoon. I have friends that have billions of dollars in real estate, but the real estate I've had through syndications or just renting a few single family homes as they've appreciated and as rents have increased. The individual stocks that I've bought. I have a SEP IRA that I started years ago that I have, I bought some ExxonMobil and a bunch of ExxonMobil in that, during COVID when oil was down so bad. So all these different things add up in the businesses that you do. It's a huge thing to hear, because when like you said, it was a fluke, and I agree. We probably can delve into that another time, but it was really trying to solve a bank's human resource problem. They were competing with these rules of ERISA, where they'd frozen a lot of the things they could do, and we were trying to solve a human resource problem so we could attract good human capital. And so it's a blessing that you've been vocal. Let's talk about some of the things that are going on now. Can you talk about ESG, environmental, social, and governance? How does that affect investors? And tell me a little bit about how that mingles with fiduciary responsibility to the investor.
Well, I've been asked about that, but I've been asked more recently a number of times about, crypto and and 401ks, being Fidelity's move in that direction. And,
yeah.
It's wacky. Unfortunately, employers have a fiduciary responsibility with these plans to act solely in the best interest of the participants.
Yeah.
And too often they don't do that. And one of the problems where they are not prudent in how they operate their plans is listening to some of the participants who push them for those type of investments. And, employers have a fiduciary responsibility when they do that. When they do that and it goes bad, they definitely can be sued because they haven't acted in the best interest of participants. So generally my advice, to individuals like you who have a SEP or solo entrepreneurs or, others who have the opportunity to save either pre-tax or after-tax is, first of all, I'm a big believer, without getting into details too deeply on it, of saving pre-tax rather than after-tax. Then, hey, take the tax savings you get if you want to, and then do those type of investments that may have a higher level of risk and, maybe potentially, like the crypto or something else, could have a bigger payoff. Use your tax break money that you get if you want to, go that route. Use that type of money.
I'd like to talk a little bit about the idea of mandated contribution. This is a wonderful debate, and it's an interesting debate. Myself, I'm sort of one of these old-fashioned freedom fighters that says, look, you let people do what they want to do. There's a certain responsibility to having freedom, and it means to learn how to be self-sufficient. And part of life is, doing all you can to be responsible for your own actions. That's not a very popular stance these days. This idea of personal responsibility is kind of passé. Ted, I don't feel old, but I feel now like I am old because all my ideas are antiquated when I put them out there in the marketplace. But the idea that, George Bush, he narrowly wins an election because of Florida. And I almost feel like, Dick Cheney said, look, if we're going to reelect it, we got to own Florida. So he goes down to Florida to make the announcement that, we're going to do prescription drugs. And, another thing he did was he said, we're going to endorse this automatic enrollment, where we're going to benefit companies that automatically enroll people in 401k. And I think that's okay, because if a person said, look, I'd rather take a more individual approach, I can opt out. But now there's rumblings of a required 3% of wages to 401k. Now, the issue I have with that is I don't know whether it's a good idea or a bad idea, but if my company has Fidelity and I don't want to put 3% of my money and have any exposure to crypto, I'm sure it's not all in crypto, of course, but the freedom to say, no, I'd like to do this myself. I want to get the education. I want to learn how to do it. How do you feel about mandated contributions? Say, look, we're going to put your money, we're going to give it to a Wall Street firm, and they're going to manage this whether you like it, how they do it or not. What's your feeling on requiring employees, not just automatic enrollment, but requiring people to put money in their retirement?
Well, I've been a big supporter of it, Andy.
Have you?
And I agree with your concept of freedom and people having responsibility to do what they should themselves. Problem is,
they
don't.
Yep, they don't.
And so I've been a big supporter of requiring all employers, to help employees save for retirement and being required to do that. And, doesn't have to be a 401k, first of all. And
right.
Secondly, when they do require employers to offer a plan and to automatically enroll participants have the right to override that. So it's not that participants don't have a choice. They have all the choices available to them that you're suggesting. It's just that rather than having to opt in, they have to decide to opt out. And the reason I favor that is I found over the years, Andy, that most employees, and I have to include myself, when I was young, had 4 dependents and a mortgage, I would have never accumulated what I did had it not been in my 401k.
Mm-hmm.
And so the biggest benefit of forced programs that require employees to help save for retirement is it comes off the top of their paycheck and enables spenders to become savers who wouldn't otherwise. That's the big advantage.
Well, I think every argument has 2 sides, and that is the legitimate part of the argument, that if people don't do what they should, it actually turns into a mess down the road, because the other side of the argument is, let's say a person doesn't, and they're a spendthrift, and they spend and spend and spend, and they never worry about tomorrow. All of a sudden they wind up, 65, 70, they can't work anymore. They're going to become dependent on the state anyway. And it's going to be a greater tax burden on those that have prepared anyway. So that is the other side of the coin, is we're trying to prevent a social problem as best we can. I can see both sides of the argument. I lean towards the freedom only because that's my nature, but I'm not beyond seeing the other side for sure, because you couldn't be more right. People should, but they don't. I mean, that's
you're the exception, and certainly there are those who have taken responsibility and done the kinds of things that you are. You certainly have a right to say, well, hey, look, I mean, they ought to do it and pay the price, if they fail to do it. But the reality is, what do you do if you got half the population who aren't covered by any retirement program other than Social Security? They reach retirement years. What the heck is that going to do to us as a country over the next 20 to 30 years? Yeah.
Let's talk about market volatility in 401ks. One of the, I have a different philosophy in that I was never a fan of pensions anyway. People, I'm rewriting my book, and I'm spending a lot of time beating on pensions, because I think people have this, they see us through rose-colored glasses of, the good old days of pensions. And, you did a great job in your book of highlighting the fact that, hey, these weren't all that good. there's not a lot of portability. And I don't know, tell me if I'm wrong. You wouldn't call yourself an actuary, but you call you self-depreciate or deprecate. You say, I was an actuarial grunt. It's what you call yourself. But you understand actuarial tables. And I think a lot of these pensions had rules set up based on actuarial information to where a lot of these people wouldn't qualify for pensions anyway, portability and age and vesting. And, there are a lot of little detail, a lot of fine print in those. But I wasn't a big fan of pensions any more than anything. And the 401k changed all that. There was, I would say this though, the major difference between a pension and 401k is simply this. If you had a pension, that was a function of your income statement. It's a function of the profit and loss. It didn't affect your assets. It didn't affect your liabilities. It basically affected your net income. 401k shifted that to where now retirement was a function of the balance sheet. It did affect your assets. It did affect your net worth. And I think that's a big shift, going from an income statement based context of retirement, where it would never end if you had one, to the hourglass of a balance sheet. So if we're going to make retirement a function of net worth rather than monthly income, a set amount, now we have market risk and systemic volatility to deal with. The dot-com crash is in 2000. We fight our way back up. The subprime meltdown is a big crash. We fight our way back up. And they call that the decade of nothing. And in retirement years, that's a huge compounding window to kind of be flat for 10 years. Now, COVID lost a third, and it rebounded in less than a year. And if you'd have told me the market would have doubled beyond what it was in less than a year, I wouldn't have believed you. But the Federal Reserve pumped in so much money. The Congress, the fiscal irresponsibility was just breathtaking to me. So now, where do you see market volatility? Right now, the Fed, I don't see the market finding a bottom until the Fed decides to become more dovish again. How does this affect the 401k balance for the person who's 55, 65 right now? Are they in trouble?
Well, in the the 401k IRA book that we talked about, I wrote that last fall, last year, and I pointed out in it that my biggest concern is those who are retired or close to retirement in these programs, 401k, IRA, etc., are taking a lot more risk than they can afford if they're listening to traditional investment advisors. And my recommendation, to them was say, look, I don't know when we're going to hit the next 40, 50% of worst meltdown. It's going to come. And I strongly recommended having at least 50% in cash. But the other issue, Andy, I want to address, and everybody here needs to understand, is regardless of what type of retirement program we're talking about, whether it's Social Security, state programs, 401ks, IRAs, whatever they are, participants in them have as much risk investment-wise as they do in 401ks and IRAs. They just don't know it.
Yeah. I think your idea of cash is huge, because if you look at Warren Buffett, he loves this sale. I mean, he's loving this. The prices will go down. He has dry powder, and he'll buy like crazy when things are on sale. And
sure.
when we're in a recession, the asset prices appreciate, maybe even a detachment from their fundamentals. These stocks get bought up simply because we're on schedule to do so, right? People are saying, well, think about that. If I put 3%, if we were to pass a law that says 3% of your money is going to go into assets, that creates a demand for those assets, whether or not they're justified fundamentally or not, whether or not a company's doing well or not. We're just pouring money into assets. And that detachment from fundamentals that can come from the Fed or any source where we decide we're going to buy securities, those securities are going to go up in price. But a fundamental investor like Buffett will say, I'm going to keep my cash just right here. Fine, thank you. Because it seems inevitable that there will be a gravity to pull us back to fundamentals. In fact, it can even swing the other way, where there's a detachment to the downside, where there's wonderful companies now that we can buy at fabulous prices if we're fundamental analysts and we just invest in companies based on their merits rather than the frenzy of stock price. Any thoughts on that idea, on the risk?
Yeah, definitely that's the case. Back in 2008, when I was, talking to participants, I told, the younger ones, I said, shoot, your chance to make a 50 to 100% return just got a whole lot better.
Yeah.
So, hey, throw as much money into these plans as you can, don't wait. Now's the time to do it. So certainly, yes. I mean, it's fear and greed are big drivers, and the problem is too many people wait and buy high and bail out when it's slow, rather than doing the reverse. And we never know when the high or the low will be, Andy. But certainly now we know we're high. I mean, right now we're higher the value than they should be. Some point. I mean, it's historical certainty. We're not ever going to have that stop. So we're able to buy the same thing that we could buy now at 40, 50% less.
Yeah. The young guy has the advantage because they have time for it to recover. Man, guy who's 65, that was, my father's a great case in point, as he retired in 1999. And so he's going to go from 65 to 75 with dot-com bust and subprime meltdown. And there's just not the income to dollar cost average in, because he'd retired in 1999. He was done. So it was an interesting thing to watch.
Yeah, that's why I'm concerned about those who are retired or near retirement.
Yeah.
Is if the first year or two early in your retirement, you take a 20, 30% loss, you're never going to recover, because what you're forced to do now is to sell more shares at a discount to produce the income you need. It's a reverse of when you're buying. When you're buying when it's dropped, it's great because you're getting more shares. Now you have to sell more shares, so you never recover. And that 4%, assuming 6%, 4% withdrawal, assuming a 6% return, works only if you don't have the big up and down swings.
We're speaking with Ted Benna, universally referred to as the father of the 401k. He's the guy that really built it and had the idea of the employee match that really gave it legs. He has many books. He has his most recent is 401ks and IRAs for Dummies, published in 2021, and I highly recommend his book 401k 40 Years Later. Just tremendous insight on those books. I want to give you a little bit of a platform. You and I spoke a little bit last time we talked. We spoke a little bit offline, and I don't want to put you in a tough situation, but I thought some of the things you said resonated with me, and I thought, I wish we'd have said that on the air. You mentioned that we have a lot of different problems politically and financially, but you said we're also in a time of moral difficulty. And, it's funny. I had 3 robocalls this morning trying to scam me out of my money before 9:00. I have people on a daily basis. I have people that imitate my Twitter page, and they might just change one letter, and then they contact my followers trying to sell them bogus, crypto investments. And I would call myself a heathen. I just, all of sin and fell short is what I would say. But would you just, I've got a few gray hairs now. And as I get older, I value, those who have wisdom of a few years behind them. Could you talk a little bit about that moral decay, if you would? I think it'd mean a lot to a lot of people, because that's not usually something I bring into the financial discussion, but it might be the root of many of these problems. You mentioned greed and fear does some weird things. What are your thoughts on that? If you wouldn't mind, and if you don't share any more than you'd like to, but you had some great thoughts on that last time we spoke.
Well, yeah, you mentioned, Andy, my faith is a major part of my life, and no question about that. And that's anything gives me peace about the future. If it wasn't for that, knowing the fact that we aren't in control, there's no question about that. There are some powerful people that may think they're in control, but they really aren't. I think it's all working out. I'm a firm student and believer and follower of the Bible, and I think it gives clear indications of the fact that things are, from a human perspective, not heading in a better direction, and people need to be probably increasing aware and thinking about that fact that times may be getting worse from all perspectives if what the Bible says is correct.
Well, in your book, 401k 40 Years Later, you mentioned that one of your concerns is that people would say, well, everything will be okay. I probably don't have to do anything about this, but you said, hey, before any type of winding up scene, you would do well to be prepared as well and to take the steps that you can to protect yourself. But as I look at the world right now, we sure solve a lot of problems if people kind of hold on to that golden rule a little bit and maybe rethink the things that are most important in their life. I mean, I see all this war, I see all this greed, and it kind of makes my heart ache a little bit. So guys like you that are honest and are genuine and are not afraid to talk about all sides of the issues, that it means a lot to me, Ted. And I've just appreciated our relationship. We don't talk. I wouldn't want to give people the impression that Ted and I go and talk every day, but whenever we do, it's always a treat for me, and I come away, with a good feeling. So I appreciate that. Anything you'd like to tell anyone about, as we close the interview, about 401k and IRAs for Dummies? I imagine they can get it on Amazon and all, the great bookstores. Your website is benna401k.com. Your preferred charity is Compassion International. I assume that's still the case. I didn't ask you about that. I just assumed it was.
Yeah, that's still good. All good, Andy. I'd say those who are involved in small businesses like you are, I would strongly recommend. There are a couple chapters in the 401k and IRAs for Dummies that focus on the types of plans available to small businesses. And if you go to page 280 in that book, you'll see there are 4 types of 401ks, and there are 2 types of employer-based IRA programs. That's 7 different possibilities. Pretty complex and confusing. And frankly, I don't know any financial advisors or even accountants from my experience who are on target with all these different types of programs. The financial people tend to push 401k because that's what they're trained to sell.
Yeah.
For many small businesses, especially those where the owners own less than 125,000 or so, the IRA-based plans may be a better option. And for one shot $200 fee, I will help a small employer if they want some additional help, to actually work through those different possibilities and decide what might make the most sense for them. So I guess that's what I'd throw in here.
Take Ted up on that, because that's more than a bargain. That's fantastic. So wonderful. We've been speaking with Ted Benna, the father of 401k, author of 401ks and IRAs for Dummies, tips for successfully managing your 401k, and the book 401k 40 Years Later. Ted, it's so nice to talk to you. Each time we have gotten together, I've just very much enjoyed your insight, and I love how vocal you are, because you're a voice people will listen to, in my opinion. And I think it's beneficial for them to understand, what you understand about this stuff. So great stuff. Hope you've enjoyed my conversation with Ted Benna on the Cashflow Academy podcast. This is where we do our very best to keep investing simple. We'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.